what's next for the property market? Joining us now is HousingWire's Logan Mohtashami. Thank you so much for being here, Logan. Really appreciate it. So does the housing market need to see some significant cracks in the labor market for affordability to come down? Is one purely necessary for the other, or is there a way to bring down housing affordability as we've seen some disinflation in other areas of the economy without labor really starting to crack?
Well, the only time we really had disinflation or deflation in housing was in like 2010 for a few months. So when people lose their jobs, they can't rent. So if you're looking for deflation, then a job loss recession could give that to you. If you're looking for disinflation, then you've got to build as many apartments and single-family homes as possible to try to cool down the growth rate of rent inflation. It's really rare in America to have rent inflation go negative. So as time goes on, more supply comes on the market, wage growth slowing down. I think wage growth slowing down would really benefit rent inflation. You put those things together, wage growth cooling down and more supply, you should get the growth rate of rents to cool enough for where the Fed will be a little bit more comfortable.
When do you expect that to happen? I feel like it's something that we've been talking about for a while. Is it within the next year, or is it further out from that?
Right now, the labor market is softening. And with a softening labor market, with job openings coming lower, the quits ratios coming down, the growth rate of wage growth should be slowing down over the next 12 months. So naturally, when we get more supply of apartments coming on, single-family rents is a whole different story. Then the growth rate of rent inflation will cool down. So the Fed should be happy about that. In regards of home prices, the first part of the year is going to show a little bit stronger data because the year-over-year comps are low. But going out for the second half of the year, the growth rate of home prices should decelerate. Our weekly tracker inventory is showing healthy inventory growth year over year, and price cut percentages are slowly rising higher. So the second half of the year should probably be a little bit more beneficial for the Federal Reserve members.
Yeah, it's interesting, Logan, to try to track the lags here, because I'm also starting to see some concern about, new multifamily housing starts have really come down a lot. And so you had this lagged response to the rise in interest rates. And so I just wonder, if you're looking at a couple of years, whether, in fact, we're ever going to get free of this extreme tight supply and high prices.
Fortunately, the 5-unit permits are already at the COVID-19 recession lows, and if they keep on continuing, they'll be at the lows of the Great Recession. So the 5-unit construction, we just got to build as many as we can or complete them. It takes 21 months to finish one of those projects. So down the line, 2 years down the line, we'll be stuck with a lack of supply in that category. Single-family rents are holding up. Single-family rents, kind of dual household incomes, that's going to be a little bit more difficult to cool down. But 5-unit permits are already at COVID-19 recession lows. So 2 years down the line, I don't think we can catch up fast enough for the apartment market. But hopefully single-family rents start to cool down when wage growth cool down. That's the best we could do with the current situation, as the Fed has kept rates higher for longer, and there's implications for the future production of housing when that happens.
Meanwhile, you got the Journal today with a piece about home prices really starting to cool in some cities in Florida and Texas. I think the line there is we're moving into a buyer's market. And then I'm seeing, Logan, a lot of charts of harmonized PCE where you strip out OER and basically you're running at target without rent. I wonder how helpful you think that is.
No. Home prices aren't part of the inflationary metrics, PCE or CPI, so I think that's a whole different conversation. What we know from our weekly tracker data is that new listings data is growing year over year. Active inventory is growing year over year. Florida and Texas is about 40% of all the growth in inventory this year. With all that said, we're still near all-time lows in active inventory and new listings data. But the growth rate of pricing should cool down. A lot of the data lines that we get, that people see the reports, are kind of lagging. But we're starting to see price cut percentages slowly move up. That's a positive for the housing market. Hopefully, we see that deceleration, especially in the last 6 months of the year, and we get some kind of stability for wages to grow up. Because at some point, mortgage rates will come down, not to 3 or 4%, but just getting down to the 6% can boost demand up a little bit, because we're the third calendar year of the lowest home sales ever. We have over 158 million people working. We have good demographics. So it really depends on how much inventory growth we could have to where we're comfortable. I think I would be much more comfortable with the housing market if everything's back to 2019 inventory levels. We're kind of not there yet. A few cities in this country are. I think those are the more healthier inventory balance parts of our country right now in terms of the home price growth cooling down in a positive way.